Good afternoon. I had the pleasure today of attending a round table discussion with a range of fund managers of the Australian market and also globally. So we had a large cap manager, we had two small cap managers, had a income focused manager and a global growth manager with also a global real estate manager, and certainly the round table provided some really fascinating insights into their views of the market and what they sort of think is likely to happen in the future. The global growth manager still remained very bullish on AI. AI obviously has been grabbing the attention. The Magnificent Seven stocks, which are the high multiple stocks and the stocks that they've lumped in that are going to be AI winners, certainly he believes is just the beginning of what's going to happen in the future. So while they've had a really good run already, his view was that the small number of stocks always drive the market forward, and it's these winners that are going to continue to drive the market forward, and that the incumbents, particularly with AI, are going to be the biggest beneficiaries because they've got the detail, because they've got the content, and because they can utilize the machine learning that they've got already to leverage into competitive advantage in the future. And certainly that was the long-term belief about that. In regards to Australian reporting season from the large cap manager, certainly results were in line sort of with expectations. Revenue held up really well, but there was signs clearly that the cost inflation and interest line was starting to have an impact, and the expenses that have gone up. One of the things that they did highlight was that capital expenditure, had significant inflation as well, which I think, is really important. And their view is that that's going to remain high. That capital expenditure inflation is going to remain high and is going to, put pressure on the bottom line of businesses. So they sort of talked about that the valuations were really high with regards to the expensive defensives, and that sort of includes Telstra, Woolworths, Coles and Transurban type of businesses. The results were good, but the valuations were too high, which saw their share prices come off. They sort of view that China stimulation is a real thing, and while it hasn't been large in quantum, they certainly see that the piecemeal stimulus that they're incorporating is going to start to work, and that's going to benefit Australia in terms of the resources. And the key resources they sort of talked about, remain sort of the lithium orientated, the battery and the carbon, beneficiaries. So companies like Pilbara, Linus and mineral resources that they felt were the ones that were going to continue to go. He pointed out that he'd been in China and that every second car that's sold in China is an electric vehicle, and that's going to be the trend in China, in Asia, and going to continue obviously globally, and Australia's going to be a beneficiary of that. The Aussie income focused manager was talking about good results with the banks. The banks are going to, margins have stabilised, the competitive nature of amongst the big four has slowed down, and so they're more oligopoly-like. They like the insurers in regards to the financials. And one of the things that they did sort of talk about, from an income point of view, that the resources, they like them. They've cut the dividends, this time around, particularly BHP and Rio with regards to the iron ore price. But, the payout ratios were also cut because of that capital expenditure inflation, and that they see that there's some good prospects going forward. They view long-term that Australia is a really good place to invest. I mean, they think, obviously, if inflation was to stay high, interest rates were to stay higher for longer, financials are a beneficiary of that, but also obviously with Australia with regards to immigration, and highlighted the fact that perhaps we're already in a per capita recession, which is down to the individual level, but from a stock and a global and an Australian economy point of view, it's going to continue to grow because of that immigration, and that the driving of new revenues to those businesses in Australia because of the results of the immigration. At the smaller end of the market, they have obviously been smashed, the small cap companies, and both the managers highlighted obviously that the valuations compared to the large caps are the largest they've been. The discounts are the largest they've been in 20 years. And I think there's a sort of a lot of reasons that they highlighted for that. Mainly that, you know, the smaller companies were having more difficulty passing on price increases than the larger businesses, and they highlighted the fact that perhaps, you know, some of the management teams were struggling with that, but also that they're sort of the systems in order to be able to do it and to be able to pass those meaningful price increases on was a difficulty. But you know, they did highlight that you know, there's a really large number of opportunities within the small cap space, and both the managers were really bullish, obviously, on that. But just from a valuation point of view, but did highlight that there was risks around the balance sheet, that if interest rates were to stay higher for longer, you know, some of the small caps are going to be worse impacted than the large caps, and really just caution to stick to those really high quality businesses rather than some of the more speculative small caps. The thing that sort of they talked about as well in regards to the small caps is the potential for continued mergers and acquisitions. With the Aussie dollar below 65 cents and private equity now sort of being able to get access to funds, they highlighted that the US bond market had opened up significantly over the last 6 months, that they felt that there might be some more acquisitions coming through in the Australian market. You've seen a couple come through in the microcap space, and you know, again, good businesses are likely to be takeover targets because they're large discounts to the valuation. The global ones that with exposure to global, you know, will be attractive for US companies and US private equity, so that you know, they're picking them up on the Aussie dollar pretty good value. The other area that they talked about was the global REITs, and while you know, they highlighted obviously the challenges around the global REITs. Largely, you know, they still have inflation increases in the rents. You know, there's obviously some valuation pressure still coming through on the office trusts. But, you know, in regards to the global REITs, they have a larger proportion of fixed debt. So again, that sort of impact of the higher interest rates won't be felt for a number of years. You know, they've got good access to capital through the debt markets over in there. And there's healthy rent growth coming through is what they highlighted, I guess, particularly around the industrial properties. You know, a couple of them highlighted the fact that they still like the outlook for energy. You know, oil and coal prices are expected to remain high because of the policy problems that the Australian government are having particularly, but also globally. I guess we've got you know, OPEC and all of those sort of things increasing the prices quite significantly. You know, I think one of the interesting things that small cap managers did highlight was again that you know, when it's difficult to buy things, and small caps are difficult to buy at the moment, when it's difficult to buy things, it's normally a really good time to do it. 20 years, you know, down relative valuation compared to the large caps. So, you know, certainly looking in that small cap space is an area where they think, you know, that there's opportunity that tends to pay off. I mean, we're not talking that it's going to happen tomorrow, but maybe sort of some of those small cap exposures, starting to increase those with a 3 to 5 year view. You know, if you have that sort of horizon, you're going to be shopping. We're going to be shopping pretty well, and two of them mentioned that. And the other sort of area that I thought was of particular interest was perhaps some of those consumer discretionary names. They highlighted 3 companies in regards to Premier Investments, JB Hi-Fi and Breville, and they highlighted the fact that Breville was 10% short, but just highlighted the fact that these are really good businesses, really well managed, good franchises and good growing earnings. And, you know, so while again, maybe the consumer is constrained for a couple of years, a lot of that's potentially factored into the share prices already. So, you know, I just wanted to bring this video to you as a update and sort of where I've been this week. So I hope you enjoy my content and look forward to presenting some more insights to you in the future.